everybody. Welcome to the CoStar News Hotels podcast. I am news editor Sean McCracken here with Peachtree's Jared Schlosser, who is head of originations and CPACE. Jared, how you doing today?
I'm doing great, Sean. How are you doing?
I'm doing good as well. So this is our third year in the row connecting with the Peachtree crew to kind of get the sense of financing to kick off the new year. Jared, let's start as big picture as we possibly can here. How would you describe the state of financing for the hotel industry right now?
I think it's a tale of two cities. I think for well thought out acquisition business plan deals, for solid cash flow, for performing deals, for strong borrowers who have, continued to do what they say they're going to do, there's tons of liquidity. Our group, went from 1.8 billion in 2024 to 3 billion in 2025, and that kind of speaks to the industry in total. I think that there's a huge demand and influx of private credit capital
Hmm.
that has created a lot of liquidity for projects. But on the flip side of that, you're starting to see a lot of deals that are struggling. Um, Note sales and note portfolios have increased substantially in the fourth quarter. And a lot of borrowers are struggling to hit their business plans regardless of asset class. So I think it's honestly a tale of two cities. The deals that are doing well, there's lots of liquidity, and the deals that are struggling will struggle to find that.
Hmm. I mean, since you bring up, kind of the struggling side of it, I do wonder, it seems like every year now at the start of the year, there's some discussion about, how much distress are we going to see out there? And there's, obviously big examples of, stuff we see out of San Francisco or like pockets of it here and there. But the wave of it that some people were hoping for a few years ago never seemed to really materialize. Do you think that this year's going to be any different in that regard?
I think it depends on what you classify as a wave,
Yeah.
right? I mean, I think it's out there. When we look at the stuff that is on our pipeline, there's a good amount of distress and, distress situations, rescue capital. We've, created a special situations fund to attack that space because we're seeing such an influx of demand.
Hmm.
But, I think people miscalculate a wave of being like the GFC, and this isn't like the
Yeah.
GFC, right? So I think it's absolutely out there. It's just, you got to dial back, what you're comparing it
Yeah, for
to
sure.
determine kind of, whether it's truly a wave or whether it's just a market segment, much like all asset classes are.
I guess that's a fair point because when's the last time we had something that you would consider normal in terms of the, ebbs and flows of the industry? It's either, the GFC or COVID or whatever. It's all just such wild fluctuations in the long term.
Yeah. I think it's, you take kind of like the timing of a lot of these transactions. We've seen a massive amount of multifamily that was originated in 2021, 2022 at very low cap rates. And, rent and performance has not increased and rates haven't gone down the way that people thought.
Yeah.
So, those assets are upside down right now and need a reset. And borrowers either had liquidity on their books to reset it or they don't. And if they don't, those deals are in trouble. Um, so there's a good amount of that out there, but like, is that a wave or is it just a normalized percentage of, what you would see traditionally? I think that's probably the better question.
Wow. Thank you for doing my job better than I am then.
I don't know about that.
So you bring up interest rates, and obviously that's been such a hot button issue, more politicized than probably any time in our lives. Like, how do you kind of parse through that noise on interest rates to get some sort of meaningful takeaway?
I mean, you kind of hit it, Sean. It's just noise. If I don't have this math in front of me, so don't hold me to it. But I think to start the year, the the 10-year treasury was around 4 to 4 and a quarter. And, I woke up this morning and I went to CNBC and looked at the 10-year treasury and it's, just under that.
Yeah.
So rates haven't really moved. I think that there's a lot of noise in the market about rate cuts and people trying to prognosticate where rates are going to be 12 months from now. If I could do that, I'd probably be doing something else. I wouldn't
Yeah.
be doing this, right?
Yeah.
But I think you can get caught up on where your baseline rates are, whether it's a treasury, whether it's SOFR, whether it's prime. But, the second you get dialed into that, the market could turn from
Mhm.
fundamentals and spreads will blow out.
Yeah,
So,
for sure.
I think these baseline whole loan rates that we're dealing with are probably here to stay. And it's just does whatever you're doing pencil to those rates or not? And look, if rates go, if you get lucky and rates go down, then great, you've got a little bit of upside. But you've got to pencil to where things are now, and I think they're going to be around the same for the foreseeable future. And at the very least, if I were buying something myself or trying to figure out a deal myself, I'd be conservative and be plugging into today's rates and not hoping for something down the line.
I mean, do you hear the opposite from people? Like, do you get a sense that there's a group of people in the industry trying to wait out monetary policy at this point, or is everybody kind of come to terms with it?
I think that when I send out a term sheet, Sean, the number one thing that's negotiated these days is the rate floor,
Mhm.
because so many people have heard, well, rates are going to get cut, rates are going to get
Yeah.
cut. People ignore things that are way more important than a rate floor,
Yeah.
and they go straight to a rate floor. And that just leads me to believe that there's just a lot of, conversation out there that, rates are just magically going to drop, 100, 200 basis points. And maybe they do, right? Again, I have no way to predict the future, but we've been saying this for the last few years and they're, relatively around the same rate as they've been since the large increase of 22.
Yeah. So, I mean, switching the topic a bit here, you started this conversation saying that, there's capital out there for the right type of borrower. Um, it seems like the trend in recent years is, even if money is available, it's a little more expensive one way or the other. Is that going to continue to be the case, or do you see any kind of shift?
I think that the type of lender is different in this
Hmm.
cycle.
Yeah, for sure.
At least in my world, I see banks shifting from lending direct to the consumer and the real estate developer to lending to private groups that are lending to that real estate consumer. And it just feels like that's where the business is going. That doesn't mean that you can't go down the street and get a bank loan, but just, if you look at that bar, that pie chart, that everybody looks at, where it used to be, life insurance companies, CMBS, banks, private capital. That private capital just continues to increase year over year, and that bank volume keeps decreasing.
Hmm.
And that's what I think. And so, when more people are borrowing from a private lender versus a bank, then that is relatively more expensive to borrow. There's trade-offs there. We have an entire business around those trade-offs,
Yeah.
right? But
Yeah.
in terms of just focusing on the overall rate, it's certainly more expensive, I think, because of that.
For sure. And you kinda answered I mean, you definitely just answered the next question I was gonna ask, which is who is out there lending right now? And, yeah, it seems like that pool of lenders has shifted. I mean, is this the long-term change, though? Like, do we think a decade from now, we're still gonna be talking about private lenders over, the regional banks that used to fill that space?
I think we are. I think that lending to an institution, at a lower attachment point, um, is a better business for a bank, and they can capture deposits and treasury management and everything that comes along with that, which is the overall goal of making a real estate loan anyway, is to
Yeah.
capture that business.
Yeah.
So my personal belief is that that is a better business for a bank, and it's classified as CNI versus real estate, from a regulatory standpoint. And so, why would you not lend to potentially a better credit institution, with a CNI loan versus, take more regulatory pressure doing a straight real estate loan?
Yeah.
Just better business for a bank. And so, as long as that's the case and regulation is what it is, you're incentivizing a bank to go in that direction. And
Mhm.
that creates increased liquidity for private capital. And I also think, like, when we started doing this, over a decade ago, the rate differential between private capital and a bank was massive, right? Today, it's really not. I
Yeah.
mean, it's probably within 50 to 100 basis points in a lot of different cases. You usually have the ability to move quicker, have a little bit more flexibility, a little bit more of a tailored business plan. So I think the trade off, for the rate differential makes more sense today than it ever did. And so I think this is more of the way the world is going to operate for the next decade versus just a specific trend.
Yeah. This might sound a little bit like a pejorative, and I really don't mean it to, but all this reads to me as like it's a great time to be the middleman, right? Like that sounds what you're saying to me, but maybe that's wrong.
No, I look, I think it is a great time to be in this business, but at the same time, it's a difficult time to be in this business because there's a lot of people that have jumped in.
Yeah. Yeah.
I think
Way
you're
more competitive than it used to be for sure.
well, it's way more competitive, but it's also who are you competing with, right? Like, I think you're what I would guess we see 3 years from now is that a lot of people couldn't put out equity. They jumped into private credit. They probably didn't know. They just figured, hey, if I'm comfortable at 100%, I'd be comfortable at 75%. And they made a bunch of loans that didn't know what they were doing. It didn't structure them right, didn't know how to asset manage or service, didn't have that in house. So they're outsourcing it. And so they run into a lot of issues, and that creates a whole different
Yeah.
you know, platform to go out and fix and solve problems.
And I imagine a lot of these, private lenders we're talking about don't have kind of the depth of expertise and, kind of specialization like a group like Peachtree. Like you guys know the hotel industry as well as, I mean, you operate and you develop and you guys have done everything. So it's not like you're just hopping in here saying, here's a opportunity to make some cash.
100%. I mean, there's not a week that goes by where we don't, bid on a loan and we lose it to somebody that's doing something where we're like, huh, that doesn't make a lot of sense, but
Yeah.
more power to them.
Yeah.
And I think that you know, that's part of where the business is evolving. And I think, it'll go back to the equilibrium at some
Hmm.
point because,
Yeah.
you can only make those mistakes one or two times before it blows things up. So, some of those people that have jumped into the market will jump out. We've already seen that. But it's definitely something that you're dealing with on a day-to-day basis.
Yeah. I mean, it's the difference between knowing a business and looking at a spreadsheet and seeing an opportunity.
That's
So
right.
I'm curious. I mean, for you guys out in the market right now, when you guys are doing deals, like what are you looking for? Like what's the sweet spot for you? What gets you excited about the market right now?
We're looking for borrowers who, have a track record and are good at their craft and know what they're doing and have a well thought out business plan, or are dealing with an issue and have a well thought out way to solve it. And then secondarily, we're looking at assets that we can underwrite. I mean,
Hmm.
it sounds simple,
Yeah.
but when you're in an environment where construction costs have gone up 30, 40%, nothing is traded, what do you comp to?
Yeah.
Right. So there's a lot of times where you're getting what looks like a really great business plan, from a construction loan standpoint, where there's not a single comp in the market, to support that. And how do you
Hmm.
underwrite that? And how do you
Yeah.
get comfortable there? without feeling like it's too pioneering and not getting paid for that risk. So um, we're very focused on staying disciplined and lending to the right sponsorship and lending on to the right assets. And that's really where we've been focused is good collateral and lending to the right people.
So you bring up construction. I'll ask about it. I feel like every year when I do this podcast, I mean, the last 2 years I asked boss Greg. This year I'll ask you. I mean, is this the year that construction comes back, or is it still the headwinds just too heavy?
I think it depends on what you're building, Sean. Like, I would tell you that if I was a developer and I could make the numbers pencil, being a hotel developer in a market where a new hotel hasn't been delivered and a lot of your competitive set has been delaying pips feels like, okay, I'm going to come in, be the nicest, newest thing. And
The
it's
appeal
going
there
to
is pretty
take my,
obvious. Yeah.
yeah, like to me, I think that's a real opportunity in 2026. There hasn't been a ton of new supply in the hotel business for the last, 36 to 5 years. So I think that it's really a compelling time to build a hotel if you have
Yeah.
the right corner, the right brand, etc. In terms of other asset classes, you still have a housing shortage. There's a lot of secondary and tertiary markets that are still vastly undersupplied. And it feels like you've gotten your basis down to a place where you can make the numbers pencil and get a decent return on cost. So that creates an opportunity. Um, and there's markets where the other food groups make sense, but there's also a lot out there that people are trying to find construction loans for. Where again, if you're building something at a per square foot that's two times what any of the trades are in that
Yeah.
market, like I just I don't know. You might be right, but you better be getting compensated for it because
Yeah.
you're
Yeah.
certainly pioneering.
Yeah. For sure. I mean, is there anything you look for? I mean, you're talking about how difficult it is to find comps on some construction deals. Like, is there something you're asking for that's novel or different than what you guys would have asked for, before the world turned upside down and we went through years and years of historically low supply growth in construction?
I think yeah, I mean, we're using a lot of data sources here that we weren't using 3 years ago. The data that you have at your fingertips today, from a demographic standpoint for things like, Placer AI and like, seeing all the different footprints that come to a location or to a retail store, way, et cetera. Like the data that you have is incredible and you're
Yeah.
asking for it. And, if you're not being supplied with it, then you can find it yourself. But between advances in AI and technology and the access to data, you're just simply able to make better decisions today than you were years ago. And like, look, you got to drill down. Like I said, it's years ago it was like, okay, I'm lending at 150 a door. There's trades at 200 a door. Like this makes sense. Like those days right now, just there's not enough transactions to really
Yeah.
tell you where market basis is and where cap rates are and all that stuff. So you've got to really drill down into the micro of each deal or it's not going to make sense.
Yeah. So obviously, as I mentioned with your title, it includes C-PACE. You guys kind of traffic in a few different forms of financing. Like, what are you seeing with C-PACE or kind of what people would classify as like alternative financing vehicles? Like, is there any trends in that space?
I think, for reasons like we're discussing, you got to know creative ways to finance stuff. I mean, I could say there's certainly, land that people own or and have owned where, development makes sense, but if you had to go buy a piece of dirt today, you're not going to figure it out with either getting incentives or some form of creative finance. I think in terms of C pace, we're in the first inning.
Yeah.
We're, not just because more, senior lenders, mezz lenders, borrowers are learning it, understanding it, and adopting it,
Yeah.
but because of the states that are coming online. I mean, you have new legislation passed in the last 24 months in Georgia, North Carolina, Tennessee, Hawaii, New Mexico, New Hampshire. All these states are coming online. All these markets within those states are coming online. So your ability to use PACE has probably quadrupled in the same time that it's becoming more accepted in the financing field.
Yeah.
Um, so, that's something that as a group we're very bullish on and will continue to be bullish on. But I mean, look, we've continued to grow our platform and find new creative ways to lend. Like, we're lending in the EB5 rural space. And we're able to provide high leverage financing to people and for those projects that can make those deals pencil where they otherwise wouldn't. And like it, I'm sure most people had never within the last 6 months had never heard that this was even out there or an option. So I think that's where you got to go is just instead of just offering a straight construction loan or a straight bridge loan, you also got to find creative ways to help your borrowers out.
So, I mean, to that last point, I want to ask you, I mean, obviously, if I'm a borrower and I see I have these options, like CPACE has a lower cost of capital, that's great. Like, I love that. But I mean, these programs, CPACE, you're supposed to be delivering energy efficiency. EB5, you're supposed to be creating jobs. Like, is there a kind of educational piece for you as the lender to say, like, all right, the numbers, they're great, but there's this deliverable you got to keep in mind in the end.
Yeah, I mean, look, whether you're providing CPACE or EB5 or just a straight bridge or construction loan, the borrower's got to perform on what they say they're going to
Yeah.
do.
Yeah.
Otherwise, it doesn't work.
Yeah.
But I think too often people make their own misconceptions or assumptions on things like CPACE, for example. Every fifth conversation I have on it, people just assume, I got to put solar panels on the roof.
Yeah.
When quite honestly, 95% of the projects, if you're building to code today, you're probably already qualifying for CPACE anyway. So you're effectively being rewarded for something that you're already doing.
Yeah.
I think that's it's more so than ever. It's about educating yourself and knowing that there's a lot of options out there that you're probably not thinking of. And if you're just trying to do, the 2005, I'm going to go build it for this, take a bank loan at this, and raise my equity at that. Those those deals are out there, but they're few and far between.
Yeah, for sure. So, before we run out of time, I guess I'll ask the last couple of questions to kind of put a button on this whole conversation. But in the broadest terms, like, how do you think 26 is going to be different than 25?
I'm not sure it's going to be.
Okay, there you go. That's a fair answer.
Again, I hate Sean prognosticating because then somebody comes back and says, "Oh, you said it was going to be this, but it's that." But
That's
like,
why I love
if,
making people prognosticate.
if you're asking me what my gut tells me, my gut tells me that we are in this time period where it is what it is. Right? The rates are what they are. The fundamentals are what they are. If you need a 25 basis point rate cut to make or break your deal, then you shouldn't be in it anyway. And I think that, you've got to adapt to the environment that we're in now. And look, I mean, I sometimes I get in trouble saying this, but like real estate is a hard business. It's not easy. And I think for a time period with rates where they were, it got easy and
Yeah.
now it's hard again and people are learning that it's hard.
Yeah.
Um and that's how it is, but no matter what economic situations happen, no matter what market situations, you have to adapt to them. And I think that 25 was about adapting and moving on. And I think 26 is, around the same.
So I guess the last question I'll ask you then is not me actually asking for a prediction, although it might sound like it. So it's more about your hopes and dreams. We had this conversation again to start off 27. What do you hope would be different, even if you feel like it's going to be the same?
I want to see acquisitions. I want to lend on acquisitions. I want the acquisitions market to move. I think all of us are in a better place if the acquisition market unthaws and people are transacting again. It's better for our business. It's better for the market
Yeah.
because it resets value and people know where, they know where the market is. And frankly, I think it's more fun, right?
Yeah.
Just candidly, like we probably did over 100 refinances at Peachtree this year, and I'm grateful for that business. But I want to see acquisitions and fresh cash come into deals and get back to doing that.
Well, that's what I hear from all the, management companies I talk to. So obviously they need change of ownership as much as anybody.
That's right.
Well, Jared, I think this has been a wonderful conversation, if not totally uplifting at certain points, but thank you for the insights. I really appreciate it.
Absolutely, man. Thank you for having me.
Hello, I'm Luke Haynes, People Newsletter Editor CoStar News, and the host of Top Credentials, a monthly podcast exploring the colourful careers of those working at the top of UK commercial real estate. In the episodes, we discover the valuable lessons influencing the daily decision-making of property sector leaders, and hear about the aspects of their job that make it a little easier to get out of bed each morning. We'll also ask for their views on the latest news and policies shaping our constantly evolving industry, and even get them to share a famous quote or song title they think defines their career or the profession. Listen on Apple Podcasts, Spotify, or wherever you get your podcasts.
This episode of the CoStar News Hotels podcast was recorded on December 19th, 2025, and edited by me, Sean McCracken. Head to costar.com/hotel news for more information on the global hotel industry, and look for all of our podcasts on Apple, Spotify, YouTube, or wherever you listen.